Happy Friday. Brian Manning here with the weekly update. Hope everybody had a wonderful snow day yesterday, blue skies today. I got out and did some skiing before work today. It was absolutely beautiful. So much snow up in the mountains, and I love spring snow. Let's see, what do we got going on this week? So, Monday, relatively quiet news day, not a lot to talk about there. Tuesday, we got the CPI reports. This is the Consumer Price Index. This is the first reading of inflation that we get on a monthly basis. So, if we look at the headline number was up 0.4%, and on a on a month-over-month basis, this was up 0.4%. On a year-over-year basis, it actually went up a little bit from 3.1 to 3.2%, so that wasn't great to see. Then we look at the core number. This strips out volatile items such as food and energy. The core number went from 3.9% down to 3.8, so not a lot of movement here. And the CPI number definitely freaked a lot of investors out, freaked out Wall Street a little bit. Mortgage rates worsened just based off this information because, again, the Federal Reserve has two mandates: price stability, which is controlling inflation, and then also employment in the U.S. So everyone is really all eyes on inflation because it's going to be an indicator for when the Federal Reserve is going to cut interest rates in the future, at least one of the indicators. So if we look at this report, it's interesting to see. So still shelter makes up a huge percentage of this. It's 45%. Owner's equivalent of rent went from 6.2% to 6%. This is such a crazy gauge of inflation. Owner's equivalent of rent is when you're being asked, if you were going to rent your home today unfurnished with no utilities, how much would you rent your home for? Just as an average American. I don't really know the answer. Maybe you do. And then to next month, you get asked the same question. And, if you're going to rent your home, how much would you rent it for? No utilities, unfurnished. And this makes up for, 33% of this number. So it's a huge number in here for modeling. Also, if we look at apparel makes up 0.02%. This was up on a month-over-month basis, 0.6%. Education was up. Airline fares makes up 0.04 of this report. Airline fares are up 3.6%. Also, motor vehicle insurance makes up 0.03 of this report. That was up almost 1%, 20% year over year. There's just some numbers in here that no matter what the Federal Reserve does with interest rates, no matter how much they hike rates or even lower rates, it's not going to have an impact on items such as motor vehicle insurance that are really 20% of this. What's interesting is if we look at Trueflation, so Trueflation is a website you can go to. Trueflation looks at millions of different data points. It looks at actual costs of goods. It's not modeling. Trueflation says that our inflation is up 9.6%, or that's the rate that we're running at. Federal Reserve's focus is to have inflation at 2% or less. So if we really follow Trueflation, they say, yeah, the US government says we're at 3.2%, but we're really seeing 1.96%. So still, to me, somewhat of a disconnect as far as the reports are concerned. What else do we get? Thursday this week, we got PPI. So this was also impactful on interest rates. PPI stands for the Producer Price Index. This measures inflation at the wholesale level. So the CPI report looks at inflation at the retail level. So what are we as consumers paying? PPI looks at inflation on the wholesale level. And the thought is, if the cost of the wholesale level were going up or down, those increases or decreases would translate over to us as far as consumers are concerned. Well, for the month of February, on a month-over-month basis, the PPI number was up 0.6%. It was expected to be up 0.3%. On a year-over-year basis, it's at 1.6%. So it's not a crazy number. It's just that it came back higher than was expected. Also, we got retail sales. Retail sales were cooler than expected. I'm not a little bit really surprised to see that because credit card delinquencies are up 3.1% and at their highest level now since 2011. So I'm still, I'm really questioning if the economy is that strong. You're just seeing, a lot of buy now, pay later, credit card delinquencies up, payday loans. We saw the employment rate move its way up to 3.9%. If inflation doesn't move in the direction that we wanted to, and these were not great inflation reports this week, really it's going to be unemployment that's going to move it. Most Federal Reserve members say they don't want to see unemployment go above 4.2%. Last week, we got employment data that showed unemployment at 3.9%. So unemployment is on the rise. So if we do continue to see unemployment on the rise, as we are seeing in the marketplace, that is going to be impactful. And that will definitely lead to Federal Reserve rate cuts. I don't think you're going to see them too soon. I personally don't know that you're going to see them, even as some predict as early as June. I think that might be a little bit too soon. It's very possible. It's hard to say, but I wouldn't be surprised if you see it later than the month of June of this year. I'm around all weekend. If you have any questions, let me know. If you want to learn how we're closing purchase transactions in 10 days, give me a call. Happy Friday. Have a great day.